Many of you have asked me for an update on ServiceNow stock. The stock is down 43% year to date. It's been a bloodbath. I told you guys my fair value was under $85 per share as of my last video. Now it's sitting at $83 per share. So it's getting very, very interesting. But it's not just ServiceNow. You have Salesforce down 37%. Adobe, I talked about it. Atlassian, which is Steam, I told you guys this one has some crazy stock-based compensation, but it's down 65% year to date. The CEO is buying a lot of stock. He said, I bought shares in the company because I'm convinced that the purchase price of $105 per share will never return. And funny enough, we're sitting at $83 per share. But the CEO is doing everything possible to try to highlight to the market that ServiceNow is not like CRM, it's not like those other stocks. It's actually an AI winner, not an AI loser. The market is not buying it. And the analysts, they keep on downgrading the stock. They downgraded it from $170 to $100 per share. That was a massive a decline in price targets. And even though they said it's better positioned for artificial intelligence era, they still downgraded the stock by $70 per share. And this is what the analysts do. They downgrade the stock when it goes down and they upgrade it when it goes up for them to be on the right side of the trade. So ServiceNow is really a funny story, because if you look at the narrative is that AI is going to disrupt ServiceNow just like it's going to disrupt every single other AI companies. Now, I believe some AI companies will actually be disrupted, but I believe it could potentially be different from ServiceNow. And I'm not the only one saying that. You have Claude, which is supposed to be disrupting ServiceNow, is actually buying ServiceNow stock. So there's some kind of a bot where it trades certain stocks from Claude. And Claude, the bot, has purchased a position in ServiceNow like 2 days ago. And this is what Claude said, which again should be disrupting ServiceNow. It says ServiceNow is now the portfolio's first direct entry into enterprise workflow SaaS, and we're initiating it because the market just handed us a gift wrapped in a category error. This is a big claim. It says on April 8th, Anthropic launched Claude Managed Agents, a cloud-hosted AI agent platform for enterprise. The market read this as AI will replace SaaS, and it sold ServiceNow down 7%. What the sell-off missed, which is that ServiceNow is an Anthropic design partner. Claude is a default model powering the ServiceNow built agent platform. This company is not a victim of AI agent build-out. It is infrastructure for it. So this is the company that's supposed to be disrupting ServiceNow. It's telling you that it's not disrupting ServiceNow, yet the stock keeps on going down. So there's nothing that could really change the sentiment on ServiceNow and on a lot of those stocks. But ServiceNow has said many times that they call themselves the tower control, I believe the control tower of AI, where they pretty much monitor AI, they govern AI agents and they regulate them, and there's the system of choice for a lot of the tasks, and they automate those tasks, and it sits on top of CRM and on top of all those platforms. So it's highly unlikely for the company to be disrupted. But the biggest concern for the disruption is the price per seat model. So because we have agents right now, AI agents, those AI agents could take a lot of seats that otherwise would have been used by a lot of different humans. So let's say, for example, one agent could do the work of 20 people, and it replaces 20 seats. And if ServiceNow is charging a price per seat, that would cause a seat compression, which would cause the earnings of ServiceNow to potentially go down. Now, there's also another thing that ServiceNow is doing, which is price per consumption, meaning how much they consume, they pay for whatever they consume. But the worry is, again, that the agent is efficient, so it will consume less, which means it will collect less and less in revenues. Well, the management team actually addressed this concern on the earnings call, and they said what we've seen customers do is they want flexibility, but they also want predictability. So without having some kind of guardrails and understanding how much they're going to spend and what are they going to get out of it, going to complete 100% consumption may be too early in some of the cases. So I think that the hybrid model has seems to be reasoning with my customers. They know what the envelopes they have and what they will be consuming beyond that and how much it will cost them. So ServiceNow is not a big fan of going 100% consumption because the customers of ServiceNow, they kind of want some predictability on how much they're paying. The per seat model gives them a budget that they're going to spend this much every month. But if they consume more, then they're going to have to spend more. If they consume less, they're going to have to spend less. So they have a hybrid model of a mix of seats and a mix of consumption. So the AI agent stuff is not really going to cause a seat or margin compression within ServiceNow. And the CEO said it himself. He said, which is why against some of the theories out there that there would be a seat compression, which is why our active user base is growing 25%. It's because they want predictability. And if it was a per consumption basis, there would be no predictability on the customer's budgets. But once you have a per seat model, then you have more predictability on how much they're paying. Now, the company is still doing extremely well. They have a 98% retention rate, which is really, really high. Their RPO, which is remaining performance obligation, has been skyrocketing to $28 billion. This is massive, which is mainly the backlog. Revenue growth is still around 20%. It's been growing 20% since June of 2024. The company's operating margin is around 13%, almost 14%, and it has been expanding over the last 5 years, and it has yet to contract. And I said it before that whenever a company is getting disrupted, they're going to have to cut prices and mass market the product for them to sell it. And you would see a margin compression. In this case, you're seeing the opposite, where margin is maintaining about 14%, and it has even expanded over the last 2 or 3 years. Now, if you look at the valuation of ServiceNow, it's trading at about 19 times earnings. This is a massive multiple contraction from 70 times earnings. The stock traded as high as 100 times earnings, 100 times earnings. Now trading at about 19.9 times earnings. It's much better valued than it was before. But I said it before that with a lot of those software stocks, especially ServiceNow, there's a lot of stock-based compensation. The best way to look at it is if you look at the difference between GAAP earnings per share and non-GAAP earnings per share, you could see where stock-based compensation is. For example, right now, ServiceNow is trading at about 19 times non-GAAP earnings per share, or of about 417. Now, if you want to use GAAP earnings per share, which adjusts for stock-based compensation, it includes everything. It's a much more honest metric, to be honest. It's trading at about 38 times earnings. So the valuation is still elevated if you use GAAP. Now, the question is, should we use GAAP or should we use non-GAAP? From my experience, most investors and analysts, they use non-GAAP whenever the market and the stock is going up because they want to justify the valuation. But then the analysts, they downgrade the stock like crazy when it's going now, and then they start to evaluate on GAAP numbers to justify the downgrade. So it's really up to the analyst and what the market is willing to pay. It has been mostly on non-GAAP over the last 10 or 15 years for most companies. But if you want to use GAAP earnings, it's still trading at 38 times GAAP earnings, which tells me that, again, there could still be further room to the downside or for a multiple contraction. Now, the best part about ServiceNow is this ratio has been improving in a major way. So if you look at stock-based compensation versus free cash flow in 2020, the ratio was really high. So there was 2.7 billion in free cash flow, and stock-based compensation was 1.6 billion. Now, as you could see here, the gap is much wider. You have 4.5 billion in free cash flow and 1.9 billion in stock-based compensation. It's still high, but the trend is getting to the better, and maybe 2 to 3 years from now, it's going to be a much smaller percentage of earnings in general and a much smaller percentage of free cash flow. So it's not really too bad, but it's something to keep in mind. And the company, again, is buying back a lot of stock for them to offset the dilution impact of stock-based compensation, and their shares have been flat pretty much over the last few years. So there hasn't really been any major dilution with the stock. Now, for me personally, I agree with Claude, you could say, and I believe that ServiceNow is getting mixed with the software sell-off. Same thing with Constellation Software that I talked about, and same thing with many stocks that will be here no matter what, but they're getting mixed up, and the algorithms is selling them all together. I think it's going to be on a case-by-case basis. Once the company proves that it's an AI winner and not an AI loser, then those stocks will start to diverge away from the software ETF and diverge away from other companies that are being disrupted, and they will trade on their own fundamentals. In terms of the stock, I believe it's, you could say, fairly valued here at 20 times non-GAAP or 38 times GAAP earnings. I still believe, there's could potentially be some more downside on the multiple. That's why I told you guys my fair value was $85 when I was trading at 110. And I think now 85 is much better valued. It could potentially be a buying opportunity. But I'm being honest again, if the market wants to now all of a sudden value it on GAAP numbers, I mean, that could still be maybe 10-15% to the downside before it gets like too cheap to ignore. I mean, Adobe is trading at 9 times non-GAAP earnings or 13 times GAAP earnings. This one is trading at 38 times, but again, it's growing 20% earnings per share instead of 10%. But I still believe, again, there could potentially be more on the downside, maybe 10, 15, 20%. I would not be surprised at all. So I believe ServiceNow is presenting a good buying opportunity, but I would not be like going all in on the stock at $83 or $85. I would potentially, if I want to buy it, buy a small position and potentially dollar cost average down and leave some room to average on the stock in case it goes lower. So that's my opinion on ServiceNow. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.